revision of financing decisions, of which I'll be able to take you through the WMCC. Yeah, and I'm using the September 2021 question number 4B. Then we have Macaulay's duration and its modification. Then we have Modigliani and Miller 1. And then, of course, we shall be able to crown everything by going out for what here? For lunch. Only 4 items. Only 4 easy items. Easy items. The earlier we finish them, the better. So we start right away with, ladies and gentlemen, this question on Dynasoft. Have you gotten the question? Dynasoft, the online ninjas, have you gotten the question? Dynasoft. So we are told there Dynasoft Limited's capital structure, which it considers optimal, is given as follows. Is given as follows. So you can see debenture capital 25, reserves 15, ordinary share capital 45, preference share capital 15, totaling to 100%. Additional information, the firm's historical EPS and the dividends per share over the last 5 years are given below. So we have years to 31st December 2016 to 2020. I can see EPSs and I can see DPSs. I think you guys are not doing the correct question. September 2021. Question number 4B. Are you able to send them a photo on their WhatsApp? Is there somebody who can send a photo on WhatsApp? Somebody please take a photo and send the question to our WhatsApp group. To our WhatsApp group. It will be really great to have everybody having the question. It will be great to have everybody having the question. So once everybody is able to get the question, please say there, why for yes? Why for yes? Why for yes? Say why for yes? Why for yes? Why for yes? Why for yes? So do you have access to it now? Do you have it now? Not yet. This lady has sent something. This lady has sent something. Okay, so now I can read it loudly from the very beginning. Dynasoft's limited capital structure, which it considers optimal, is given as follows. So we have debenture capital 25, reserves 15, ordinary share capital 45, preference share capital, all totaling to 100. The firm's historical EPS and DPS over the 5 years are given there, note 2. The company's ordinary share capital shares currently, they are selling at 50 per share at the securities exchange. New ordinary shares will be sold at this very price. 3. The company's expected net income for the year ended 31st December 2020 is 40 million. Dynasoft Limited adopts a constant payout ratio of 40% as its dividends policy. The company can raise additional capital as follows to finance acceptable investment projects. Equity capital utilize all available retained earnings for the year ending 31st December 2020. Any extra equity will be raised through the issue of new ordinary shares at a flotation cost of 10% of the issue price. So you're told preference share capital, new preference shares will be issued at 11% coupon rate. The par value of each share is shillings 100. New preference shares will be issued at par, subject to a flotation cost of 5 per share. Debentures, new debentures can be sold at a coupon rate of 13%. The debentures will be issued at par. Corporation tax rate is 30%. Required, calculate the breakpoints in the marginal cost of capital schedule. That is really, really easy. So we start with our optimal capital structure. Optimal capital structure, the question is here. September 2021, question number 4B. So we start with the optimal capital structure. Optimal capital structure. So the optimal capital structure, this is how it shall look like. We have equity, we have a debt, we have preference there. Equity, debt, and preference. So we know that equity in this capital structure given to us, equity will be what plus what? Equity, we are looking at what belongs to the shareholders. So we have ordinary shares and any reserves. So the equity here will be ordinary share capital plus reserves. So in that case here, we have ordinary share capital is 45. And then reserves are how many? 15. Which gives me how much? 60. Which gives me 60. Yeah. And then I can see debt amount, the debenture. You know, debenture is debt, eh? So debenture is debt. So this debenture, ladies and gentlemen, is coming to how much here? Debenture 25. And then the preference, I can see preference there is 15, giving me 100. So in form of weights, because I'm interested in the weights, this will be divided by 100, divided by 100, divided by 100. So these are the weights, my good students. So the weights here, we have weight of equity, 0.6. We have weight of debt, 0.25. We have weight of a preference, which will be 0.15, like that. 0.15, like that. All right. All right. So then once you have gotten that, my good students, we can very easily give our examiner the weights. So come and give me the weights, not weights, but breakpoints of equity. 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 Yeah. Breakpoints of equity. Breakpoints of equity. So breakpoints of equity, ladies and gentlemen, they can't see the board. Are you able to see the board? Why? Why can they not see the board? Because I'm able to see the board myself. I'm able to see the board. Yeah, they can see the board. Yeah. So breakpoints of equity, remember equity has got two components under the breakpoints. We have what we call retained earnings, and then ordinary shares. So first of all, I would want somebody to give me the retained earnings. So give me the retained earnings. Give me the retained earnings. So retained earnings, what do I have there as retained earnings? So retained earnings, how much do I have here as retained earnings? 24 million, right? So they're telling me it is 24 million because they have read somewhere here where they have told us, note number 3, they have told us that the company's net income is 40 million. So the net income is 40 million. Then also Limited adopts a constant payout ratio of 40%. So if you're paying 40%, it means you're retaining 60%. So retained earnings, this will be 60% of our net income, 40 million. So then this gives us, some ninjas have told me it's 24 million, isn't it? Yeah. So then give me the first breakpoint. So breakpoint 1, do you remember the formula? The formula for breakpoint, we take the maximum equity amount all over weight of equity. Maximum equity amount all over weight of equity. So from the retained earnings equity amount, I can get comfortably 24 million, right? 24 million divided by the weight of equity which you had obtained, which was 0. What here, somebody? 6. So 24 million divided by 0.6 gives me 40 million. So this gives me 40 million. 40 million. I'm so sure all of us would have gotten this correctly. Yeah, so the topic is financing decisions, and we are doing this question September 2021, question number 4B, and we are revising basically. It's revision. We are revising. These special revision classes, we use them for revision because they are not part of our timetable. All right. So then we have here 40 million. Now, ladies and gentlemen, after that, go ahead and give me the breakpoint for ordinary shares. Breakpoint for ordinary shares. Go ahead and give me breakpoint for ordinary shares. Breakpoint for ordinary shares. Still within equity. Still within equity. So that will be breakpoint 2, ordinary share capital. So are you able to see under ordinary share capital, what have they told us? Under ordinary share capital, if you look at the table under note 4, they are speaking to equity capital. They are telling us equity capital utilize all available retained earnings for the year ending 31st December 2020. Any extra equity will be raised through issue of new ordinary shares, which is pretty good. At a flotation cost of how much, ladies and gentlemen? 10%. But they're not telling us that from this ordinary share capital, you can get a maximum amount of maybe 30 million or 50 million. So they are not giving us a cap. The cap is not being given here. The maximum is not being given here. Look at the formula for getting breakpoint. It's maximum equity amount. So in this case, it means that breakpoint 2 for ordinary share capital, there is no maximum. So this is infinity. Because they have not specified the maximum. Maximum has not been specified. So are we together there? Great. Then now we can comfortably go to the next component of our capital structure, which is debt. Can you kindly give me the breakpoint of debt, and then I'll be able to give you a gift. Breakpoint of debt. Breakpoint of debt. Breakpoint of debt. And I would want to pause a little bit and ask whether the 8 p.m. students and the 5 a.m. students, have you done this topic with your teachers? Have you done it? Oh, then we are revising then. We are revising, yeah. We are revising. So go ahead and give us the breakpoint of debt. Breakpoint of debt. You write the formula first. So breakpoint of debt, it will be maximum debt amount. Maximum debt amount over weight of debt, which I can comfortably see, weight of debt is 0.25. We are normally lucky because in most cases, the examiner will not give you the maximum amount. The examiner won't give you the maximum amount. If you read that note number 4 under debentures, you see debentures are our debt instruments. Yeah, note 4, debentures. New debentures can be sold at a coupon of 13%. The debentures will be issued at par. There is nowhere they are giving us any maximum amount. So basically, the breakpoint for debt will be what here, somebody in infinity. There is nowhere they are giving us the maximum debt amount available. Now from there, we can easily go to the preference. From there, we can easily go to the preference. So you mentioned there, breakpoint of what here? Preference share capital. So always write the formula because you will end up getting a mark, even if it's 0.5. So breakpoint of preference share capital, this will be the maximum preference share capital amount over the weight of preference. And if you read note number 4, under preference share capital, they are talking about par value. They are talking about coupon rate of 11%. They are talking about flotation cost, yes, but there is nowhere. They are defining the maximum amount that you can borrow using this particular source. So there is no maximum amount. So again, we are telling our examiner that the breakpoint will be what here, somebody? Will be infinity. Breakpoint will be infinity. Breakpoint will be infinity. Breakpoint will be infinity. So now we have finished Roman 1, where they wanted us to calculate the breakpoint in the marginal cost of capital schedule. So number 1, complete. Then now we go to number 2, W MCC in each of the intervals. W, weight, yeah, sorry for that, weight of preference. So they want us to give them the WMCC. So they want us to give them the WMCC. So they want us to give them the WMCC. So remember, which question are we doing? This is September. Don't forget that this is September. September, yeah, 2021, question 4B. Question 4B, yeah. September 2021, question number 4B. So how do we get WMCC in this case? Weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt, and this cost of debt must always be after what year? After tax. Remember, KP is preference share dividends, KP. This cost of preference, this is dividends of preference shares. These are dividends of ordinary shares. And the dividends are never allowable for tax. But KD is interest. And the interest is normally allowed for tax purposes. Interest is normally allowed for tax purposes. So you see, I don't have a problem with weights. Weights already we have them, isn't it? So what I do not have are these parameters. So we start with cost of capital, cost of equity, yeah, which is KE. KE, cost of equity, which is KE. Remember, we have got two types of cost of equity. Do you remember them? We have cost of equity retained earnings here, and then we have cost of equity, ordinary share capital. Are you able to remind us the formula for getting cost of equity? Yeah, it is DO into 1 plus G over P0, isn't it? Or P0. I like how you're calling it, P0. Yeah, and then plus what here, somebody? Plus G, yes. Plus G. Remember, for retained earnings, you can never subtract flotation because this is money that you already have in the bank account. It's a reserve. It's a reserve. So cost of equity, retained earnings, we have this as DO into 1 plus G all over PO plus G like that. Whenever you see examiner giving you many dividends, many fruits, you can see in this case here, the examiner has given you 5 dividends, 5 DPSs. Look at note number 1. Note number 1, are you able to see the DPSs there? Yeah, note number 1, I can see the DPSs. I can see the DPSs. And retained earnings, yeah. Although retained earnings is part of what here? A reserve, yeah. So in this particular case, ladies and gentlemen, whenever you see the examiner giving you many dividends, they want you to use those many dividends to compute growth rate. At this level, if I were even to be the examiner, I can't give you growth rate directly. Growth rate, students shall compute growth rate. There are 2 ways of computing growth rate, and I'll be able to show them to you right now. The first method is where we say growth rate equals current DPS over oldest DPS, and then you take the nth root, yeah, and then you say minus what here, somebody? Minus 1 like that. So this is a very powerful formula for getting growth rate. You take the nth root of the current DPS, all over the oldest DPS. All over the oldest DPS, minus 1. Now remember, the dividends given to us by the examiner, are here. We can see they are 2016, 2017, 2018, 2019, 2020. All right. So the DPS, don't copy EPS. They're putting EPS there to confuse you. Yeah, because they would want you to repeat this paper. So DPS is 3.10. Then we have 3.30. Then we have 3.50. And then lastly, 3.6. So remember, the very oldest, it will be this one, DO, D1, D2, D3, and then D what here, somebody? D4. So when you look at, first of all, yeah, you can either use here n minus 1 or n, doesn't matter. N minus 1 or just n, it doesn't matter. So in this particular case, my good students, my G will be equal to the number of years in between. Number of years in between here. So basically you are counting like this: 1, 2, 3, 4. Or basically you pick it from here, D4, 4. N, you pick it from here, 4. So fourth root. So we have here fourth root of the most current dividend. It will be this 3.6. Most current dividend will be 3.6 divided by the oldest dividend, which is what here, somebody? Which is 3, isn't it? The oldest dividend is 3 here. Yeah. And then whatever answer we shall get, we shall come and say minus 1. Minus 1. Minus 1. Minus 1. So long as you remember that the very initial dividend, you give it D0, and then you count like that. You'll be able to get the Dn. N here is 4, because we measure up to Dn. N in this case here is 4. Fourth root. Fourth root. So fourth root. In your calculator, then you'll be able to see the x root. In your calculator there, you'll be able to see the x root. Please don't use the square root. Don't use the square root. Use the x root. Please use the x root. X root like this. So you say shift. Yeah, first of all, you say 4. You will say 4, and then you press shift until you see that x root has come. Once it comes, you put this in brackets always. Always. Yeah. Yeah. So in this case here, we have here 3.6 divided by 3. Yeah, 3.6 divided by 3. And then whatever answer now you get, after you say close brackets, you say minus 1. You say minus 1. You say minus 1. And then you tell me what answer are you able to get. What answer are we able to get? 4.66, eh? Or 4.67? Who is telling me the truth? Now, there are students who are saying that n minus 1 and n will not give us the same answer. Eh? I think I've made myself clear. And really, you see the student who is making use of that n minus 1, the n then will be 5. Eh? You'll say 5 minus, which will give you 4. They'll give the same answer. It is the logic, basically. It is the logic. Is there somebody who is able to confirm that the two methods will give us the same answer? Anybody who is able to confirm that the two methods will give us the same answer? It will give us the same answer. It is the logic. It is the logic. It is the logic. Same answer. So long as you don't say that 4 minus 1 again. Remember the number of years were 5. 1, 2, 3, 4, 5. 5. So ensure that you are able to use the x root. X root. So you say 4. It will be the same. Are you getting this 0.467? 0.0467. Now, let me tell you something. For some reason, there are students who will never master. For some reason, there are students who will never master how to get the x root. You see, if you have the cube root of x, you see cube root of x is the same as x raised to power what? A third. If we have, for example, fifth root of x, this will be the same as x raised to what here, somebody? A fifth. So those students, what I normally tell them, I will tell them this fourth root, you come and do it this way. So it will be 3.6 over 3, but now you say raised to power what here, somebody? 1 over 4. All of us, we have to do this. We have to do this. In your calculator, open brackets, you say 3.6 divided by 3, you close bracket, and then now you press raised to. You'll be able to see raised to. And then you put this a quarter in brackets. You put a quarter in brackets, and then you say minus 1. Will we end up getting the same answer? I haven't seen you guys doing that. Will we end up getting the same answer? Will we end up getting the same answer? will we end up getting the same answer? And at times, this is even easier. Instead of looking at those X roots, you simply, if, for example, you get somebody telling you that they want you to get maybe the sixth root of, say, 30/4, like that, then what do? It's very easy. You'll come and say this is the same as 30/4 raised to power 1 over what? Raised to power 1 over what here? 6 years. It will be exactly the same. It will be exactly the same. Let me repeat this. Ladies and gentlemen, my G here, so I'll come and say G is 3.6/4 raised to like this, a quarter, raised to a quarter, and then I subtract what here? I subtract 1. So long as I remember to put everything really contextually in brackets. So I'll come and say open brackets, 3.6 divided by 4, close brackets. You say raised to, open brackets, 1/4, you close. And then whatever answer you will get, you will end up subtracting 1, which will end up giving you, ladies and gentlemen, 0.0467, which is the same as 4.67 what here? Percent, which is the same as 4.67%. I'm getting 0.7. Yeah, don't worry. Where could you be going wrong, EM? Jaribu kutumia raised. Sema tu open brackets, 3.6M. I'll be very happy to assist you. 3.6 divided by 4, you close. And then you say raised to. There is a raised to there. Open brackets, don't forget to open brackets. Open brackets, a quarter, 1 divided by 4. 1 divided by 4, and then you close again. Don't subtract before you close. You must close. And then you say now -1. You'll be able to see this is the correct answer. This should be the correct answer. So I can only continue once M gets that 4.67. If M does not get that 4.67, then great. Yeah, great. You must have forgotten in this case here to do what here? To really put this in brackets. So 4.67. I will come back to the second method of getting G, but before that, we are getting cost of equity retained earnings, which is DO into 1 plus G, all over PO, and then at the end of the day, we must talk about what here? Growth being added there. Now remember, we have 5 types of dividends. This DO is normally the most recent. You see, they have given you 5. You know, we are about predicting. Say that Mwalimu wrote DO as 3. No, that is now very old. The most recent dividend per share is 3.1. Here, somebody. It's 3.6, the most recent now. When I come to the formula, use the most recent because it is a forward ever, backward never. Don't go in this case here. We only use those old dividends for purposes of computing G. Otherwise, just like it is in salvation, it is forward ever, backward never. Into 1 plus growth rate, which we guys got as 0.0467, isn't it? Over PO. PO is the current market price per share. Get information regarding the current market price per share. Have they given me that information anywhere? Is there a place where they have given me the current market price per share? Which note is that? Note number 2, eh? So note number 2, they have told me the company's ordinary shares currently are selling at 50. They are selling at 50. Remember, O means today. Today is current. So the current price of a share. So it's 50. So when I do my abracadabra punch this, 3.6 into 1.0467 close, divided by 50, whatever answer I get, I will come and add 0.0467 to it. The growth rate is normally independent. It's normally independent. So do we have a very good ninja who already has this number? A very good ninja who already has this number? A very good ninja who already has this number? Who already has this number? So we have in this case here 12.2. 12.22. 12.21 or 12.22. This is supposed to be 0.4666. Who is now telling me the truth? Because initially when I wrote it down, it was 67. It's supposed to be 66. So 66 wameshinda. It's supposed to be 66. It's supposed to be 666. All right. So then, ladies and gentlemen, you'll be able to come here and give me the cost of equity, retained earnings, which then, whatever answer you get, multiply it with 100%, they are getting 12.21%. Is that okay? 12.21, can we, all of us, work with 12.21%? All of us, we work with 12.21%. Thank you so much. Sorry. Let me see here. Somebody has a question. I normally don't get questions from what I wrote first. Yeah, I normally don't get questions from my physical students totally. But we agreed last time that this time around, the physical students I got geniuses, right? Yeah, so I rub. Already there is nothing in. But let's agree, all of us. I want us to agree, all of us. Are we getting 12.21%? 12.21%. After you multiply with 100, are we getting? Thank you so much. All of us, we are comfortable with that number. All of us, we are comfortable with that number. Atapita bila kubomoa kamera yangu. All right, great. Thank you so much. Thank you so much. Now, retained earnings, we are through with that. But remember, we are calculating cost of equity, which has got two components: cost of equity retained earnings, and then we have cost of equity ordinary shares. So is there somebody who can just give me the formula for cost of equity ordinary shares? Ordinary shares, somebody write it down. So for cost of equity ordinary, the same thing with retained earnings. So we have DO into 1 plus G all over PO minus what here, somebody? Yeah, ordinary shares you must sweat. Look at how Dr. Ruto is really sweating to sell shares of what here, Kenya Pipeline. There will be a lot of work to be done, prospectuses to be developed. In this case here, lots of marketing outside here. So whenever you want to float shares, it won't be for free. There must be flotation costs. And then, of course, at the end of the day, we have plus what here? Plus G. Never forget, over something like 40% of students will always forget this G. Let that not be your portion. So here I have everything except flotation cost. So have they given me flotation costs anywhere? Which note? Yeah, they are talking about note number 4, equity capital. They are talking about a flotation cost of 10% of the issue price. So it will be 10% of PO, 10% of the price per share. And you are the great ladies and gentlemen who told me that the price per share is 50, isn't it? Yeah, price per share is 50. So then this translates to what here, somebody? This translates to 5. This translates to 5. This translates to 5. This translates to 5. Thank you so much. So, and then we have now everything that can enable us get this case. Case is cost of equity shares, cost of equity ordinary shares. Now we have everything. We have everything that can easily give us. We have everything that can easily give us. We have everything that can easily give us. So we have here cost of equity shares. DO, you guys had given me the most recent dividends, which are dividends payable in 2023.6. You went ahead and gave me the growth rate, which was 0.0466, isn't it? All over PO, which is 50, minus our flotation cost of 5. Whatever answer we shall get, we shall come and add this 0.466 like that. So ensure you're using your brackets very well. If I were you, I would say 3.6 times this brackets divided by 45 first. Whatever answer I get, I say divided by 0.046. So then what answer are we able at the end of the day here? 0.1303, which is the same as 13.03%. The online ninjas, are they able to get? They are actually giving me the figure. The online ninjas are giving me the figure. Very good. Ladies and gentlemen, that is really good. Then we go to cost of debt. Now we are through with equity costs. Now it is the debt costs. Can I remain silent a little bit to see whether their students will be able to give me the cost of debt? Yeah, I should be able to remain silent a little bit and see whether their students, will be able to give us cost of debt. Cost of debt. So for us, we have got two types of debt instruments. We have irredeemable, and then we have redeemable. Yeah, you need to know how to get the cost of those two types of debt. So this one that I have here is irredeemable. How do I know it's irredeemable? Irredeemable, that no redemption. So it's irredeemable. We will never return it because basically there is no N. This is a bank loan. This is a bank loan. There is no maturity period given. No maturity period given. No maturity period is given. If you look at the debt that we have, ladies and gentlemen, look at the debt, the debentures. The debentures, they are telling us that new debentures can be sold at a coupon rate of 13%. The debentures will be issued at what year, somebody? At par. So there is nowhere they are mentioning N, number of years. So we shall assume that we are going to have this in perpetuity. Yeah, and even ourselves, ladies and gentlemen, there is no single minute you as an individual or as a company, you are supposed to stay without a loan. You shall always have loans and loans and loans and loans. Of course, except from Muslims. I know they don't believe in this. Yeah, you should always have loans and loans so that when you die, God forbid, when in this case here, we shall be having these mourners crying so seriously, we should have a few of them crying, not because of how good you are, but because of their money that you have died with, isn't it? And they can't raise that up. Yeah, they can't raise that up. You can only be another type of a person if you go claiming a loan amount from somebody who has already died. That is dead capital. Leave it. So basically, if it's a bank loan, then that will be always presumed to be irredeemable. Somebody anasema fuliza, unajua ni kama kitu, for example, like myself, we normally charge our properties. You shall never discharge a property. Atumepatia property, Equity Bank, when we take through lawyers, that a lengthy process of charging it. And then once, in this case here, you finish paying your loan, you want them to discharge? No. If you do that, then you're not a very good student of Modigliani Miller. As we shall be seeing later in today's class, Modigliani Miller says that value of a levered farm will always be equal to value of an unlevered, somebody does not have debt, plus in this case here, debt times what here, somebody? You can see debt adds onto your value. So long as you're not that type of a person. Kama rafiki yangu mwingine nilipigia, alikuwa amepata loan, mwalimu. Ilikuwa inakuja kitu kama hii. Ilikuwa na vitu juu hapa something. Akaniambia, sasa mwalimu, because nimepata hii pesa namna hii, ati hizi za juu hizi ni saka. Hiyo saka za mti. Ati sasa mwalimu kuja tukamate kitu na hii, ati tukatakata hii, alafu ndio baki ati 1.8, ati ndio hii ata inive. Everything will end up being suckers. You must know how to utilize loan money. Loan money is not to be played about. If you want really to harness maximum value from your loans. All right, so let's continue. So then if that is the case, if it's irredeemable, to get after tax KD, you will simply take before tax KD, and then you subtract what year? The taxation. If it's a bank loan, if it doesn't have N, we'll be able to see, ladies and gentlemen, that that's how we handle it. So like in this particular case, after tax KD, they have given us the before. The coupon rate is before tax. Coupon rate given there is before tax, and it is what percentage? 13. It's always before tax. So 13% into 1 minus tax, which is 30%, isn't it? Are you able to see the tax rate? Tax rate has been given before required. Before required, they have given us there the rate of tax, which is what percentage? 30%. They have given us the rate of tax, which is 30%, like that. 30%, like that. So then the after tax KD gave you guys what figure? After tax KD gave you guys what figure? 9.1%. 9.1%. That is it. Then now we talk about cost of what year? Reference. Yes. Yes. Yeah, we shall be handling a very good question. Thank you very much for being the first student to ask me a question. Yeah, in the classroom. That is very, very good. I should even give you a present today, right? Yeah. Or you also have a second question. Yes, very good, serious questions over here. So the first question I'll be handling this question where they give us maturity, right? For redeemable. When they give us redeemable, we'll be doing a similar question today. And then she's asking a very, very good question. What if we go to an exam and then we realize that this examiner is just another examiner? He has not given us tax rate. So as a finance student, will you assume it's 30%? Will you assume it is 30%? No. In finance, we don't assume. Issues of tax, we don't assume. So if the examiner does not give us tax rate, we shall always assume it is what here? Zero. Zero. The assumption is zero, not 30%, not 30%. Ignore. Ignore. Thank you so much. Thank you so much. And then now we go to cost of preference shares. Cost of preference. Cost of preference shares. Cost of preference shares. KP. Cost of preference shares. Cost of preference shares. Thank you so much. So KP, I love KP a lot because preference dividends don't have growth rate. Preference dividends normally come with a fixed rate of return. Fixed rate of return. So then I will be able to say here, KP is preference dividend. Preference dividend. Dividend over net proceeds. Over net proceeds times 100. Net proceeds times 100. Net proceeds. What do you mean, Mwalimu, by net proceeds? What I mean here, ladies and gentlemen, is that I will take this preference dividend. Yeah. We divide this by the market value of preference share, minus any flotations, minus any discounts. Minus any discounts. The same is applicable to bonds, even shares. If you're told that shares are issued at a discount of 2, then you must subtract that discount. Because we're looking at how much are we earning as an organization. Yeah. So anytime they want us to give them KP, we shall take preference dividends. We divide by market value of the preference share. We subtract any flotation costs and any discounts, of which you don't have discounts in this question. Yeah. So are you able to see the preference dividends, you good students of mine? Preference dividends. How much do we have there as preference dividends? How much do we have there as preference dividends? In this question, have they given us preference? Yeah. You can see, ladies and gentlemen. You can see, ladies and gentlemen, that the new preference shares will be issued at par. Will be issued at par under preference. No. Bond or debt is different from preference share capital. They're different. Okay. They're different. They're quite different. They're quite different. Yeah, they are different sources of capital. They are different sources of capital. Thank you so much. It is because of the positioning of my camera. My camera is positioned in a way that I can easily be hiding the things I write, but I will try to be very careful. I'll be looking at the camera quite a lot. So the preference dividend, they have given me a coupon rate, which is 11%, isn't it? Times the par. So it is 11%, and I can see the par is 100. The par is 100 times the par value. So then this gives me how much? 11 bob, isn't it? And then I can now come here. I say this will be 11 divided by market value of preference shares. They have just told me up there that each preference share will be selling at par. So then we're going to realize how much here ourselves? 100. Are you able to see that? They are not able to see that. They have been able to tell us, ladies and gentlemen, there, preference share capital, that new preference shares will be issued at 11% coupon rate. The par value of each share is 100. New preference shares will be issued at par, subject to a flotation cost of what year? New preference shares will be issued, will be sold at par, and the par is 100, subject to a flotation cost of 5. So then this will be the same as 11 over 95 times 100. 11 over 95 times 100, which will end up giving us what figure, KP? A ninja called Francis is giving me 11.58. 11.58. 11.58. 11.58. So then could you kindly do me a summary before we go to any other thing? Do Mwalimu a summary. Let's do Mwalimu a summary. We have in this case here, equity. Equity. So equity, we have cost of equity 1 or cost of equity retained earnings. Just a summary. You also have to write this summary. You must also write this summary. So this one here was coming to how much? Cost of equity retained earnings. 11? 12.21. Yeah. How about cost of equity ordinary shares? 13.03, isn't it? So we have breakpoint 1. For equity, we have breakpoint 1. Equity, we have breakpoint 1. If you can remember, we have breakpoint 1 for equity. 4 million, eh? 24 million. 24 million. How about breakpoint 2? We got breakpoint 2 under equity as in fee? Infinity. You must do this summary. Everybody must write this summary. You must write this summary. And then you go to debt, my good students. So debt, if I remember very well, we just had 1 KD. We just had one KD. And it came to 9 point. Oh, this figure is wrong, eh? Who gave me 24 million? 24 million is the retained earnings, eh? I want the breakpoint. Breakpoint is 40 million. Thank you so much for that correction. Thank you so much for that correction. Thank you so much for that correction. How about the after-tax KD1? After-tax KD1, after-tax KD1, after-tax KD1, after-tax KD1, 9.1%. Oh, I'm alone, but I will overcome. And therefore, we only have 1 BP. We only have a BP1. We only have 1 BP. And this BP, of course, must have been infinity, isn't it? Infinity. Infinity. And then we have preference. Preference. So we have KP. I remember very well, you guys gave me KP of 11.53. 11.58. Thank you so much. 0.58. Therefore, I know that even BP here will be infinity. When BP is only 1, I mean, that must be infinity. When you have only 1 K, then the BP should be infinity. 1 K, BP should always be infinity. But when you have like 2 of them, then you'll have like that. Now, ladies and gentlemen, having done that kind of a wonderful job, now I can go to doing the MCC schedule. This MCC schedule is what I would want to see whether I have my students who will be able to do it without struggling. The MCC schedule. Do we have anybody who can do this without struggling at all? Yes. Because under the MCC schedule, first of all, you give us a column for breakpoints in ascending order. Ascending order. Breakpoints in ascending order. Fortunately, if you look at the breakpoints here, we only have 1. How I wish we had 2. I'll get a question that has got 2. A question that has got 2. So in this case, it's only 1, isn't it? So we talk of 40 million. And then, of course, the other one is what? Infinity. 40 million and infinity. And then now you give us what we call the financing range. So you give us what we call the financing range. The financing range. Tell me the first class. How will the first class look like? Don't say 0 to 40 like that. No. No. There's a language. There's a language we normally use. 0 up to 40. Don't forget that. So 0 up to 40 million. After that, how will the second class read like? Not 40, over 40. So we have here over 40 million up to what now here? Up to infinity. Over 40 million up to infinity. Over 40 million up to infinity. Those are the financing ranges that we have. And for these financing ranges, I would want to see how you ninjas will post the cost of equity. Let me see how you will post the cost of equity. Let me see how you will post the cost of equity from the summary. From the summary. From the summary. From the summary. So I know that cost of equity 1, which is 12.21%, runs up to what? Runs up to 40 million. So this 12.21 runs up to, so it will be in this class, 12.21%. And then now beyond the 40 million, we go to KE2. So now KE2 is the one which is 13.03%, which runs up to infinity now. So up to infinity. So you can see this is over. So up to infinity. So it comes here, 13.03%. Can you kindly post for me KP first? It doesn't matter. You can do KP or KD, doesn't matter. So please post for me KD. Sorry. Yeah, post for me KD, abracadabra. Post for me KD or KP, doesn't matter, whichever. Whichever. Let's start with the P. So P, I have 11.58%, and this is running all through to infinity. It doesn't matter the financing range. So it will be 11.58. How many times will I post 11.58 there? Twice, yes. Because this 11.58 is going all through up to infinity. So we have 11.58, 11.58%, 11.58%. Then give me KD. This KD as well, you can see KD is 9.1% running through all financing ranges at 9.1%. So we have here 9.1%, 9.1%. Is that okay? And remember, this KD is after who? You've already adjusted for tax. You've already adjusted for tax. So the only thing that I wish you to give me are the weights now. So we start with weight of equity. What was the weight of equity from the structure? Yeah, 0.6, eh? 0.6. How about weight of KP? Weight of P, I mean, weight of P. 40% uongo. 0.15. How about weight of debt? 0.25. Now, are you able to give me the WMCC? Are you able to give me the WMCC? The weight of marginal cost of capital. It's very, very easy. Very, very easy. So you take like the first one. I would want to be very, very clear. I would want to be very clear. So WMCC for the first financing range, 0 up to 40 million. WMCC. So it will be 12.21 times the weight of equity there, which is 0.6, plus 11.58, yeah, times 0.15, plus 9.1% times 0.25, which will end up giving us what figure? 11.58. You don't have to write this, right? You don't have to write this at all. What you need to do is just to see the format. You take this times this, plus this times this, plus this times this, which they're giving me a figure of 11.34. 11.34%. How about the second class? Second class, I'm taking this times 0.6 plus this times 0.15 plus 9.1 times 0.25. Give me an answer here. 11.83%. And remember, this is supposed to be incremental, eh? You know the difference between WMCC and WACC. WMCC is the cost of acquiring an extra source of debt, an extra source of capital. So I expect these extra layers to be a little bit expensive because, of course, as you increase the loan amount, the banks perceive you to be riskier. So they increase the cost of lending like that. So then you have been able to answer Roman 3 of this question. Roman 3 of this question. Any question? Anybody who has a question? Are we able to follow, especially the online students? Are you able to follow what I'm doing? Because it will be very, very bad for me to bring all of you here over 120 students to waste your time. It will be really bad and sad. It will be very, very bad. They're able to follow. That is really, really good. Really, really good. Really good. Now, from there, ladies and gentlemen, we shall do the last part. The last part of this question, yeah, Dinosoft Limited, they're talking about Dinosoft Limited has the following potential investment opportunities. So we have projects W, whatever, yeah, using investment opportunity schedule, IOS, a device on which projects to accept and hence determine the firm's optimal capital budget. So whenever you're given projects of those nature, we said that the first thing you need to do is to rank those projects based on IRR. That is the first thing you're supposed to do. The higher the IRR, the better. The higher the IRR, the better. In most cases, and I'm going to talk to these examiners to avoid doing this. I'll talk to them tomorrow. Because in most cases, they have given us projects that are well arranged. They should never do that. A good examiner shall endeavor, in this case here, to confuse a student. Confuse a student a little bit, isn't it? Here they are giving you, oh, I'm rubbing so fast. Sorry for that. So you think that's bad advice? Because they are always bringing us this. Always. They are always bringing this. Very well arranged, which is wrong, isn't it? Just continue. I'm trying to fix something. What could be wrong? This charger. So somebody is saying that any ink you put on this paper, you earn a mark, eh? No.